Welcome back to our Digital Trader Summit series. Exactly a year ago, we started our webinars and we made it to episode 20. So I'm really happy to see so many of you back in our webinar. As enmacc is expanding across Europe, we are looking more and more into the opportunities in these, for us, new markets. Last time we were discussing the power market of France. And today we'll look into the Spanish power market. And quite naturally, the starting point for that is the PPA business, where Spain has all of our attention in leading this kind of new way of building renewables across Europe. So we invited an real expert on the topic. I'm very happy to have Javier with us from AFRY. As a consultant, he has more than 16 years of experience in the field, and he's leading the energy market practice of AFRY, looking to consulting investors, regulators, market participants, and has a real view on the influencing factors on the market and how to model them as well when it comes to price predictions, forecasts in the long run. So I'm very happy to have him with us, and I'm directly handing over to Javier, and I hope to be back with you with many questions at the end of his presentation. Thanks a lot. Javier, the floor is yours.
Hello, Jens, and everyone in the audience. You can hear me fine, right? Okay, yeah, so great pleasure to be here and share our views with enmacc and the enmacc's community. Today I'm not a trader myself, as I told Jens, so I'm not going to speak about the technical details of trading, but more try to bring our view on how we see the market actually in the medium and long term. Actually, our models are also useful for short term, which is where trading is very, very necessary. I'll make some comments about short-term prices, but really the focus, at least of my speech today, is more the medium and long run to understand where the market we think is heading and how trading and PPAs are necessary in this environment. Okay. So I'll share my screen. Should be working now. So very few words. Oops. So the agenda, just very few words about AFRY, a short introduction on an overview of the Spanish market, let's say the past and the present. Then a few words on the future targets. We'll see whether they are achieved or not, but what the targets are. I'll give our views on actually the future we see, which is not necessarily fully aligned with the targets. And then some words on how PPAs and trading fit in this future. So AFRY, for those of you who hear AFRY for the first time, we are the merger of OF, actually A with a circle, pronounced OF of Swedish origin, with PPAs, pronounced in the Finnish way with the umlaut. At least we've gotten rid of the symbols in our name. I think we have progressed here. And we actually pronounce it AFRY now. Okay, so it was created in 2019, and which is when we launched the brand, and now fully operating as AFRY. But we are, actually myself, I come from the PPA side, and all the consulting that we do in the energy space is actually the PPA team, which is now the consulting branch, or the consulting division of the AFRY group. Okay, we have a global presence in about 50 countries, almost 2 billion revenues. You can look at our numbers in the webpage. So as an overview of the Spanish market, just for those of you who don't know where we are, currently we have a quite balanced capacity mix with 7 nuclear reactors. Some coal, there was up to 10 gigawatts of coal until 2019, half of which has already closed. The other half will close in the next few years. So no coal, you'll see a slide about our view on the future capacity mix. Basically, no coal from 2025 onwards. So we made a bit of a different decision than you have in Germany, where you close nuclear, keep some coal. In Spain, it's for now the political choice is the opposite, and the economics are also going the other direction, keeping the nuclear. According to the current plan, the last reactor would stay operational until 2035, while coal will decommission in the next few years. Then 50 turbines, 50 CCGTs, quite some hydro, of which about 3.5 gigawatts are pump storage, pure pump storage, a bit more storage in conventional dams, some cogeneration, here in black mostly, with some biomass and a few other renewable technologies with small capacities, quite some wind, 26, almost 27 gigawatts of wind in the mainland, and then solar PV, which started in a big boom in 2007 and 8. Actually, this boom here was so costly that, as I guess many of you know, the system, not only the costs increased a lot because of subsidies that were given to lots of megawatts here, but also the financial crisis was very strong in Spain, with demand, as you see, decreasing strongly. And this means that there was a problem of a tariff deficit, which I guess many of you are familiar with. And basically, until 2019, there was no renewable basically installed in Spain, until the economic landscape has completely changed. Okay. So just showing some figures here on where the historic power prices have been. You see on the left, annual baseload prices, which have been driven very much by commodities and rainfall. Indirectly, even though the Spanish capacity mix doesn't burn any oil in any plant today, there was some fuel oil, but only CCGTs now that burn gas. Because of the indexation of gas contracts to oil, at least in the old days, this indexation is declining. But this means that when oil prices have been high, gas prices have been high, and therefore electricity has been high. Okay, with some impact on rainfall, which, as you will see, is pretty substantial in Spain. This is just showing monthly volatility. There is the only trend that is quite repetitive is spring being cheaper, because gas tends to be cheaper, demand is lower, rainfall is high, wind is high, and we lately have the highest prices towards the end of the year, when there's when demand is higher on the higher end, and there's little wind, little hydro, and there starts being less sun. So this is, as you see, where we typically get the high prices. Is just showing the hourly volatility of prices, going basically from zero. Generally, in most years, we don't have scarcity pricing in Spain because the Spanish capacity mix is very oversupplied. We've got a good 10 gigawatts of capacity in excess of the worst peak demand. So the spikes you see here are driven by cost of gas, which, as I guess all traders are familiar with. They skyrocketed a few weeks ago, a couple months ago, because of the cold in Asia, and the very high demand in Asia. How do Spanish prices compare to European? They tend to be on the higher end for several reasons. Gas in Spain is at a slight premium over the rest of Europe. And also there are tax reasons. There's a Spanish tax which was created in 2012, which makes every single plant bid 7% higher, because there's a direct tax on revenues. So we tend to be a bit more expensive than other markets. At least it's 7%. For a few years there were additional levies on gas and coal, which made thermal plants bid even higher. And so because of the structure of the capacity mix, the cost of acquiring gas, which is a bit more expensive, a bit cheaper than Italy, but a bit more expensive than in Central Europe, we tend to be on the higher end. And here you see February. This is the last week of February. And as you see, there are hours in the European market where interconnections make all prices in many markets coincide, except for Italy, which has some bottlenecks in the borders and has more expensive gas. But as you see, many markets are many hours exactly coinciding because of interconnections, and some hours interconnections are not enough. And you see that when there are surpluses of renewables in a given market, this can be Spain in this week, but in other weeks it's the opposite. It's Germany or Netherlands or France going even into negative. Markets are decoupled in prices, which makes a good opportunity for trading. Now, electricity prices have been very driven by commodities. You've got the numbers and the graphs here, so I won't go over them. Just say that they are very volatile. In the case of gas, because of the very different costs between short-run and long-run marginal costs, which you need to bid depending on the supply-demand balance in the world and depending where the gas is coming from. There's sort of, excluding the pandemic with very, very low prices here, which no one expected, there's sort of floor around 10 euros per megawatt hour and the cap around 30 euros, which is sort of the band we expect where gas prices can fluctuate in the future with a rising trend, but always staying generally in the 20s in the future, which is sort of the long run marginal cost, which is stable in the long run. Then you see on the right, carbon prices also very volatile, very driven by politics. Not that politicians decide the price, they decide the allowances in the market. So they do decide what the supply of allowances is, and this obviously has a big impact on prices. So depending on political decisions and what happens also on the demand side for allowances, as you see, there have been big changes. We actually expect, well, we think that today prices are speculative. So the fundamentals in our models, they don't support such high levels. We think there's some, precisely some talking about trading. We think it's really traders bringing prices up. I mean, prices would not need to be in the level they are today to comply with the level of allowances. But because in the end, you can see this as a financial asset. It is a financial asset in the sense that you can buy today and sell it in 2, 3, 5 years time. If your expectation is that prices will rise in line with the new, very ambitious decarbonization targets, you can buy expensive today just because you'll sell more expensive in the future. Basic trading, right? This is showing the frequency of curtailments on a monthly basis, just to show that very wet years, like for example, 2014, 2013 were wet years. What you see is that typically in February, March, and April, these are the months when you can have very high frequency of curtailments. Basically, when there are curtailments, market curtailments, or market-wide curtailments, prices collapse down to zero. So all these hours, it's basically almost free electricity in the wholesale market. And these frequency of curtailments went down in 2015 because of a new interconnection and new pump storage. Then they went down, but as we keep increasing the penetration of renewables, these numbers will go back up actually to situations as we have seen in the past already. With 2021, precisely here, the red one, you see almost 20% of the hours in February, we've had curtailments and very low prices. Now, renewables in Spain, in the past, they have been developed always on the back of support schemes from the government. Initially a feed-in tariff, then a new scheme based on a reasonable return. Even the auctions that were held in 2016 and 17, as you see, after several years with absolutely no activity in the Spanish sector, because there was no grid parity, so impossible to develop on a merchant basis, and there was no incentive, so basically impossible to develop renewables. Then we've seen a boom which started again. Most of this capacity here was developed thanks to some auctions that were held in 2016 and 17 with a pretty complex mechanism based in a reasonable return over the life of the asset. Effectively, actually, they are merchant projects which just have a floor which help the financing. Okay, but this is most of these you can see them as merchant projects really. Now, what's going to happen between 2020 and 2030? There's going to be a combination of projects with a CFD, a new scheme which has been created in the last year. So a feed-in tariff, sort of a feed-in tariff with a CFD. I'd call it rather a pseudo CFD because there are some caveats to the CFD. And they are going to live with merchant renewables, which have already started. Actually, some of the projects you see here, they are fully merchant projects, not under the auctions, neither the old ones of 2016-17 nor the new ones. Actually, the new ones, they happened in January last year. In January this year, and COD is expected for 2023 and 24. That's when the first projects of under the new scheme will be operational. Now, just a comment which I think not many investors really understand. So the situation where we come from is very high LCOEs, actually in the 400s in the case of PV, and in the 70 or 90 euros in the case of wind in those years here. Power price is definitely below those figures, which means incentives were needed. Now, costs have gone down, as we all know. Let's say LCOE, round number, we are in the 30, 35 euros for PV. And I've heard some investors or some market experts say, we are at grid parity, there's no coming back, and now the market never again needs auctions. Actually, I couldn't be, I think they couldn't be more wrong in making this assumption. I definitely disagree with this statement because it is all in the future of power prices, right? I mean, if we indeed are in the future in a situation where your LCOE is here and average market revenues are above this figure over the life of your asset, you will make your returns. You are in grid parity. Now, if we happen to have a future which for several reasons could potentially go in this direction, with power prices going below your LCOE, and when you put this in our financial model, you don't get your return. Basically, you are not in grid parity. At least I would say you are not in grid parity. What you are is in apparent grid parity or starting grid parity, not necessarily meeting your returns. And the reasons why prices could go here are several. One is commodities could collapse. Another is LCOE of future investors could go very low. Therefore, future investors will depress prices and they will not care about past investors. Or you can have a government which, regardless of LCOEs and economics, they can push the renewable penetration to very high levels with auctions and a CFD, which complements revenues to future investors, but not to past investors. So this is just a risk, okay? This is not our central expectation, but this is actually, conceptually, this is what we see if the Spanish renewable energy targets were achieved through auctions or through very cheap renewables in the future. So careful with assuming that this means grid parity, careful with assuming that will make your returns, okay? It's all about having a view of the future. What are these future targets? So from the Paris Agreement, basically keeping the increase in world temperature below 2 degrees, ideally between 1.5 degrees in this century. This translates into European ambitions, which for now have been set for 2030 in a binding way. And as a goal, I guess you're all familiar with the net zero target by 2050, no net emissions by 2050. This has a translation into Spanish targets. There are two targets. One is the European version, the NECP, the National Energy and Climate Plan, where Spain stated our ambition to go from 20% we are today over final energy up to 42, which in turn means 74% on electricity, and even a bit more than that in the mainland. And there's a draft energy transition law, which is actually a bit less ambitious. So we've told Europe more ambitious targets than we have told ourselves in the law. And then this is backed by auctions. The government is basically saying, in case the market would fail to deliver those targets, and for several other reasons. We want to develop auctions that guarantee a minimum development of wind and solar. We also want the auctions enable to decrease even further the prices to consumers because the expected clearing prices are below the pool price, which means that actually renewables under the auctions are going to give money to the system. They're not only not taking money, they're actually giving money to the system, at least during the first few years. Okay, so this is where we are heading with a minimum calendar of auctions of 3.5 gigawatts per year, the target being almost double that figure. So basically the government is expecting some merchant activity, either with PPAs or without PPAs. That's irrelevant to the government. It's all about developing those roughly 6 gigawatts per year at least, okay? You've got some graphs here just to showing where different European countries want to go. Okay, you've got the slides and you've got the reference. You can check a very nice website here, a blog, which shows in a very nice way all the ambition. I'll just state that from this figure, what you see is Spain basically being on the most aggressive, I don't know if call it optimistic or ambitious, both in the target and in the gap to get to that target. So orange and red, basically Spain, Netherlands, Denmark, Ireland being the most ambitious. This is the gap you see here. So basically the effort in how many new renewables need to be added to the system. So lots of activity coming in the Spanish market. This is the trend. So the brown one here on the right, you see the megawatts that the government seeks to develop. On the left, you see the renewable renewable penetration target over the electricity system. What we state here with the blue is that we think the market would not deliver the targets unless it is complemented by auctions. This is because there is an obvious interaction between prices and the capacity mix. The more renewables you develop, the lower the prices, and the lower the prices, the lower the incentive to develop renewables. So we think, and I think we are the only consultant stating this, that we do think that auctions are actually needed if the target is to achieve said ambitious plans. Some people think that just because, as you see here, this is the connection requests, 70 gigawatts of grid connections, of megawatts have the grid connection agreement with the TSO, 131 gigawatts have the grid access. Lots of investors think that their projects will go forward because they do have the grid access. Yeah, they couldn't be more wrong in assuming that all of these will get built. As you see, this is what we expect. There's about 4 to 5 times higher investment appetite and development activity than what we think is realistic. So big threat to development and big threat to power prices. Our assumption is based on the capacity mix being somewhere between the blue and the brown. Eventually, the brown could be exceeded, meaning that investors in the short term could manage to develop even more because there's lots of activity with PPAs or even with fully merchant financing. We would then expect that market signals start saying that there has been an overinvestment. So it could well be the case that in the first 5 years, there's a big boom, and then 25 to 30 market signals actually cool down the expectations of the market. We'll see. And this is really not about economics. It's really more about the permitting and the financing, how agile those will be, and what the bottlenecks are in effectively managing to develop every project that investors would like to develop currently. So lots of opportunities to develop renewables under auctions, merchant, with PPA, without PPA. PPAs can be physical, they can be financial. And then we do expect that there will be a wave of new types of investments off grid to develop specific hydrogen projects. We'll see about those. There are lots of politics and subsidies which will have a big relevance on how many of these projects on the right really materialize. This is just showing that curtailments will be unavoidable. This is an illustrative, but it's all on scale. So demand here in the continuous line on a standard day, let's say in March, April, May, in let's say anywhere between 2025 and 2030. This is how demand can be increased, or system load can be increased with exports, storage, and even hydrogen, as long as this hydrogen is connected to the grid, which is not at all to be taken for granted, because lots of the hydrogen is thought to go offline. And as you see, even with exports and pump storage, and this is also on scale, what you see here is how many kilowatt hours or megawatt hours 5 million electric vehicles would need on a daily basis. So you can put these here in the middle of the night or at noon, but you can't put them everywhere, because that's once you fill these, cars are charged, no more charging possibility. Okay, so this all translates into, by the way, these are the targets in gigawatts. So such a scenario with the political plan being achieved, it comes necessarily with lots of curtailments and a very high frequency of low prices. Okay, so the question is how much, and how do you finance and how do you make an investment decision with these risks? So just some figures here, which you can see in the slides. I'll just comment that we expect curtailments to start rising substantially in the next 5 years, especially, and they are very dependent on weather patterns. So typically very humid years, they increase curtailments a lot. So you can expect in normal or dry years, very little curtailments. In wet years, which we have almost 1 year in 2, or at most 1 year in 3, this goes exponential. And this is because we have lots of run-of river during many months, just as we had in February. And this here, the scale, the legend is weather patterns we apply to the future modeling of the market. Okay. So rising level of curtailments, rising frequency, high impact on weather patterns. So really understand, this is something to be understood because we see this as unavoidable. Some illustration here on hourly prices, how 2018 on top looks very different from what we expect for 2030. This is wet years, which look pretty scary, as you see, with high frequency of low prices for quite a long period. This is a good opportunity for a long-term storage, maybe hydrogen production. Definitely not a big business case for small batteries, which in these situations would actually not make lots of money. In dry years, as you see, things look a lot better from the perspective of the generator of keeping prices high. And all of this will depend on how many nuclears are closed, how many EVs, how much storage is effectively developed, how much electrolysis, and we keep monitoring all of this to try build consistent views and be realistic of what's expected. I'm just showing here our expectation on LCOEs, which, as you see, have a pretty big range depending on the project, capex, load factor, and so on, but also on whether we talk about LCOEs for a merchant project which needs high returns, or for a project under a feed-in tariff, which can live with much lower revenues because they are guaranteed. So this should tell people that market prices in the future going in this direction would be consistent even without auctions. So you should understand the impact of cost reductions in potentially bringing prices down. They can stay above these figures. That's perfectly possible in a scenario where commodities are high and there are strong bottlenecks in the development. I don't think there would be bottlenecks in the financing if prices stay up here. Basically, this is extremely high returns for every single developer, but it is possible. There's also a future in which power prices could even go below if low commodities, let's say in a crisis context in a given year, is complemented with very high capacity developed under auctions and a CFD bringing additional money to future investors. So careful with understanding where power prices could go on a merchant basis, and even worse on a subsidized in a subsidized world. Okay, this is and this is LCOE, and the yellow here is where capture prices could eventually go. Now, I can say that our view is that in general the market will be driving investments. So we don't see revenues down here in our central scenario. But we also think there will not be very strong bottlenecks. So we don't see prices staying up here. So I'm giving, I think, a pretty good view of where the range of prices where we think the market is going. This is the results of the auctions, with most bidders, both wind and solar, having bid 25 euros per megawatt hour for a maximum period of 12 years, which in fact we think is going to be close to 8 or 9, because once the minimum energy is supplied, you can voluntarily opt out. We think that's actually what will happen. So effectively, this is basically a CFD or a pseudo CFD that will last 8 or 9 years. And then from this figure, people or investors will see the revenues step up to whatever your central view of the market is in the 2030s or 40s. And this is part of the explanation why people can bid low, because basically you expect revenues rising at some point. But lots of questions here on, well, whether all these projects will manage to get built. They have 3 years, 2 for PV, 3 years for wind to be developed. We do think that most of it will get built. Some projects might struggle. Actually, some of them might opt out of this mechanism, lose the guarantees, and find the PPA eventually. That's better. If they do, I guess some investor will be happy to lose a guarantee in exchange for going into a better deal than an 8 to 12 years CFD with the government at 25 euros. Now, a couple of scenarios here, they are conceptual. What I want to show here is that in a context where the government would not develop much capacity under auctions, then chances are capture prices in the market will stay a bit higher. PPAs will coexist, offering a discount, and auctions can also coexist with further discounts. Typically because the Spanish system has a higher credit rating than any off-taker. I'm not sure that's true for Apple, which I think has a higher credit rating than the Spanish government. But leaving this aside, basically this is conceptually the future we would expect. But then capacity might not deliver the targets, the political targets. Now, if the government wants to deliver the targets no matter what and increases eventually the volume of auctions, this is conceptually what I showed before, with potentially capture prices even going below LCOE of future projects, just because investors are investing with additional revenues provided by a CFD under these auctions. So this is a risk which we think will not happen, but it is a risk that we do think investors should understand, because if there's a big wave of investment, either driven by the current uncoordination of merchant investments or by future strong decreases in LCOEs, or by the government being very aggressive, positively aggressive with auctions, this is definitely a possibility. And when we do the maths and we do these numbers with very big detail, this is conceptually what could happen. A few words which also matter to trading are our views on the whole capacity mix. Thermal going down with coal and nuclear, I mentioned, closing at some point, and the difference between the derated capacity and the expected peak demand in let's say in a 1 winter in 10 winter, this will shrink in the future. And this means 2 things: either prices will start going very high in these years, eventually, when reaching scarcity pricing, or if the government doesn't want this to happen, then additional backup capacity will need to come either from additional storage, very likely from storage, or potentially from peakers, gas turbines. But there's definitely a possibility of prices at some point going into scarcity pricing on the back of the decade, depending on how much capacity we close and depending on how much new firm capacity is incentivized to come in the system. Without incentives or a new revenue stream, we actually don't see batteries nor pump storage happening. So it's really in the hands of the government to actually bring batteries and storage with a mechanism which is yet to be designed. Last few words on on PPAs and trading. So why PPAs? From the producer perspective, because it's actually a very important tool to finance and build a project. You can get a project built either participating in the auction, but that's if you're a PV developer, there's going to be 1.8 gigawatts auctioned each year, maybe more, but definitely not 10 or 15. So if you are not a winner in the auction, either you go fully merchant, which is very, very risky, and financing will be extremely difficult. It is already, there is some financing today, but it will be more and more difficult with fewer and fewer banks joining this possibility. So most banks will require a PPA. So basically, it's a must, there are high chances it will be a must to finance a project. Well, obviously, unless you can finance with corporate debt, big utility could. But for most developers which do need some debt financing, it's either a PPA to lock this minimum return. I call this PPA also buying yourself a good sleep during those years. Basically, you stop caring about the very high volatility which will come in the system, as you have seen, with high with some rising frequency of very low prices, also a few periods of very high prices, but precisely when there's no wind and no sun. So it's not the prices that renewables will capture. And this is, of course, in exchange for probably sacrificing some return. I say probably because it's as I said, it's all in your future views of the market. If you have the view that Spain is going to be flooded with renewables because of a potential overinvestment, then complemented by lots of auctions, actually you may think that the PPA today is a bad deal, and it may turn out to be a very good deal if we go into these very very low figures. Now, as an off-taker, I think all off-takers, this is the reason number one. They state we want to be 100% green. The real reason, I think, is really this reason number two. It's the fact that as an off-taker, you are in a situation where you are in a good position to get lower prices than market expectation. So if market expectation is, I don't know, in a given period at 40 euros, you can actually lock lower prices than those 40. PPA is now being definitely below those figures for pay as produce. Obviously, lots of positive aspects like contributing to renewable targets, jobs, and so on. And of course, you're giving this in exchange for assuming a very big risk, which few corporate companies and few suppliers can actually grant. Which is the reason why PPAs are pretty difficult to agree. Or they seem easy until you go to the last clauses and you start speaking about guarantees. And this is what ruins, I think, 90% of PPAs. So few people can actually provide those guarantees to cover for, let's say, a low probability, but very high impact risk of being locked for a few years into a contract which is out of the money for several years. Now, beyond PPAs, because there's definitely not going to be a PPA for everyone that would like to have one to develop a project. As you saw, there's much higher investment appetite than auction capacity and also than PPA potential. We would expect that in the next few years, there's somewhere between 3-5 gigawatts of additional PPAs. I'd say a very maximum of 10 gigawatts in the next few years. Which is much less than the investment appetite. This means that if you don't have PPA, what are the options? You need to find other hedges, and this is where trading comes in. So who is interested in trading energy? Suppliers, generators, consumer traders, lots of purposes. You can either hedge physical delivery, close some positions between gas and electricity. So you buy the gas and you sell the electricity, or vice versa. Smoothen working capital issues, cross-border physical supply with lots of differences in prices, in concurrent prices in different markets. You can actually buy electricity in France and sell in Spain, buying some capacity in the borders in annual or monthly explicit auctions of capacity. There's a lot of trading in this space. speculative revenues with either financial PPAs or just trading in the forward markets. To back a PPA, to avoid complexity or lack of PPAs. I mean, a PPA is several months negotiation, 70 pages, lots of lawyers, the expensive ones, and locking yourself into a forward product is a few clicks, right? With lots of numbers to be done, but it's not months of negotiating 50, 70 pages. Lots of trading happening across years. I mean, buying today for year plus 1, year plus 2. I think clearing houses are trying to offer products up to calendar plus 10, just because it's plus 10 is the nice and very common maturity of PPAs. Month ahead, week ahead, they had up to continuous trading and balancing. All the timeframes definitely need training to optimize revenues. Cross-border, national or zonal. There are some markets like Italy or the Nordics where different price zones within a market. Products, base load products is the more standard. Peak of peak used to be traded. I think it's going to be less and less relevant, just because 8 to 8 more and more means nothing. 8 to 8 just means that, you know, if it's sunny, you get one price. If it's not, you get another. So I think peak of peak products will go down. I would expect that solar products go very much up. Wind patterns, there's a problem that wind patterns are very different. So I think what I saw from enmacc is very good and very useful in offering the possibility to upload a wind profile, and you can quote. It would be very, very useful to say, this is my wind pattern, who can quote me a price for this? Or you can trade any commodity you can think of. And you can trade options, just like in financial markets. I guess you're familiar with these possibilities. So the future power markets will definitely need rising hedging, diversifying and trading to maximize business sustainability. So last few words, you know, in the Spanish market, we have 4 decades, possibly more, but at least 4 decades of very steady and consistent need for both wind and solar projects. So my advice here is don't try to build everything in the next couple of years and go into a boom and then a bust. You know, time the investment, understand that capex will go down. Market premiums, in our views, are likely to reduce when more projects are available to the market and financing conditions worsen, which means that potentially from a seller's market, we'll go into a buyer's market, which means premiums would definitely go down if this really happens. And we think it's quite unavoidable that this happens, because there's not a market for 100 gigawatts of new wind and solar projects. So know your key exposure factors, develop early stage if you can, and hedge, diversify, and be very familiar with all the trading tools, because you're definitely going to be in a world where you need to be very active from the year ahead to the several years ahead, down to the minute ahead, to try maximize your revenues. So basically, I think we're going to a world which needs a holistic risk management philosophy. If you're just on one side and just with one asset, chances are there will be good periods and very bad periods. So we think a new approach needs to be taken to manage risk in a much more holistic way, with a business that's on both sides, integrated vertically, horizontally, which is diversified in many ways. And definitely it's a new market with lots of trading. So I think the enmacc products, gens, which I have seen, I think they are fantastic. It's a tool which is very flexible, allows very flexible and get quotes for new products which are not traded. So great perspectives, as I see it, for the enmacc community. And that's it on my end.
Thank you, Javier. Thanks for the great presentation. Lots of content and even the details here. I learned a lot already. There are quite some questions we're getting from the audience, and I'm happy now to get in a discussion with you. I think what many get really their interest is this graph you have shown with the stars, yeah, where you showed that there are significant bottlenecks. So huge appetite for investments, but significant bottlenecks on the permission side, on the financing side. Is this transparent to everyone, or because you only a fraction of them will be built from your assumptions?
I said this before, there is a forest out there, and I think quite some investors are looking at their tree and not really looking at the forest behind. I mean, this information, it's of course it's all public. Yeah. You click in the Red Eléctrica's website and you see all the status of connection requests. It's exactly the same figures I showed. I mean, it's a difficult situation for investors. On one, because you know, people care about their development, they care about doing things right, getting a good project, getting the land, getting everything done. And that's as much as a development team can do. That's as much as you can ask them, right? Do your job right. Now, I think it is for managers to understand that the market size is what it is. You know, the Spanish demand is what it is. It will take a few years to start rising with electric vehicles, hydrogen. You know, the demand is going to rise very little in this decade. It will start rising a bit more in the next decade, and then quite a lot in the 40s with a good 100 terawatts almost of additional demand from EVs. But that's not happening this decade, definitely not in the first 5 years. And so someone needs to have the big picture in mind and understand that all those projects will not go forward. It's just impossible. At least there is no demand for it. And because electricity demand, as I said, it is what it is. It can be exported to a certain extent. There are 3 gigawatts now, 5 gigawatts interconnection with France in the future. With Portugal, we can pretty much forget about it because it's the same system. When it's windy here, it's windy in Portugal, and vice versa. So let's say the door to exporting to Europe is limited. Actually, Europe cannot always take Iberia and renewables because Europe is also developing renewables. And I've shown in other presentations and in some posts how there are situations where Spain is actually curtailing renewables and importing from Europe because Netherlands is in negative or Germany is in negative. So this needs to be understood. How do you manage such a business? Well, just keep in mind that you know, as a manager of a developer, you're not going to develop your whole pipeline because again, the market doesn't allow for you and all other developers, which are also good in developing, for all of you to develop projects, and also be realistic about assumptions, you know, and understand that even I'm very transparent with our assumptions. I always say that projections without assumptions are completely useless. You know, our assumptions are, you've seen the figures, 3 to 4 gigawatts are developed, but very honestly, I have no clue whether it could be double. Eventually, you know, I think it will not happen. Obviously, our assumptions are very reasoned. We think about every single detail that goes in our models, but it could very well be the case that we get this completely wrong. And there's a good, I don't know, instead of 4, it could be 6, it could be 8 gigawatts. It could be 15 is the appetite per year. And it could be a lot more. So I'm very transparently, if we fail to see that the permitting and the financing might eventually enable substantially more capacity than we are assuming, then AFRY central projections are very likely to not be reached. And outcome prices in our numbers, they are pretty clear that they would be even lower. So it's really for the investor to take to understand the risk, to understand our assumptions, to understand the limits to how much we can predict such assumptions, and it's really for them to to understand the assumptions they plug in their models, the megawatts they prepare for, the money they raise, and then the whole hedging strategy they have. Yep. There are definitely lots of things that can be done. That's where we want to be helpful to clients. but it's really their decision to make realistic assumptions or not.
But what are you saying, to be a little bit provocative now, is that you're saying huge interest, but many of the investors don't see the risks, and
Absolutely.
probably the risks and the returns are not in balance.
I mean, it's either what I see in being involved in transactions, seeing people's views, what they plug in their plans. I'm not very clear on what can happen. What's very clear to us is it can be the very high megawatts and the very high prices. It's one or the other. Either there are some bottlenecks in the permitting, in the financing, and the megawatts are much, much lower than the addition of investors' expectations all combined.
Yep.
Or if even half of the investors' appetite, if you take the press releases, you add everything that investors have said they will develop, you halve that, and then you plug this half into a model, and power prices are very much lower than AFRY Central. Yeah. I mean, if the megawatts in the first few years, if there's a boom in investment, I really don't see how we can escape the very high frequency of curtailments. So, and I think it can be somewhere in between, with, I think in Spain, we like booms and busts. I mean, we possibly, the whole investor community fails possibly, and I don't think it's specific to Spain and the power sector. I think many sectors, when you see an opportunity, there's lots of investment, and only when, let's say the boom has been confirmed, and we are in a situation where the market is oversupplied, that's when suddenly there's a bust and the merchant activity stops. So it could be the case that if the permitting and financing is more agile than we currently think, and there's a bit more investment than we currently think, we would expect that there's a good 5 years of developing projects, and then we would expect market signals start telling investors we need to cool down and bring down the pace. Always, with the trend in the long term is very clear. Even in our low scenario, I can say by 2050 and 2060, we see way above 100 gigawatts of PV. That's even in the low scenarios. The long run is very clear. The question is the timings, and the potential cycles of high prices driven by commodities, but also low prices driven by volatile commodities, combined with a potential, let's say, overinvestment. And by overinvestment, I mean investment above a more reasonable and sustainable trend.
You touched upon the second big risk, curtailment or cannibalization effects in renewables. What role do you see playing batteries there, or hydrogen as well? Is this already part of your outlook, or is it hard to grasp?
Yeah, very good point. It's the two new buzzwords in every energy conference. There's PPAs, batteries, and hydrogen. So on batteries, we do consider they will come. The whole energy transition doesn't make sense without storage. The question is when, and the question is also what needs to happen for those batteries to be a reality. As things stand today, with current costs and the current regulatory framework, we don't see batteries happening anytime soon. Now, we do see them happening because we do have a strong view that the government will develop some, we can call it an incentive, or we can call it a service. Something needs to be created so that an additional revenue stream is provided. And we've done lots of analysis on, obviously the easy one is price arbitrage. That's by far not enough to pay for batteries, nor pump storage, nor any storage, at least with our CapEx assumptions. Not now, not in 2025, not in 2030, even with strong CapEx reduction assumptions on batteries. Now there's an additional revenue stream, which we also project, which is all revenues in ancillary services. There are substantially revenues to be made there, providing secondary bonds, secondary tertiary reserves, and so on. In our numbers, we expect that even with those additional revenues, chances are that this will not be enough. And so we do think that batteries will come, but only when the government puts in place this new service or this new incentive, and there are several forms it can take. We've actually been proactive in trying to propose what we think works. We're trying to bring with industry a proposal, a very detailed proposal to the government, because honestly, I think it's really not an easy task. You could think it's just about writing, taking a piece of paper and writing some regulation, some incentive. It's really years of negotiating and complying, with a very complex regulatory framework at European level and at national level. So we think it will take a couple of years to decide. We think the regulators will succeed in finding this regulatory mechanism, which means that we do start seeing batteries happening in 2025, but only as many megawatts as are incentivized or as part of this new service that the government needs to create. So we do think some batteries come between 2025 and 2030, not before, because there are not the economics, even though legally and technically you can, with the new regulations that have been passed in the past few months, but the economics don't work. So what the regulation needs to do is go one step further and actually find a way to incentivize batteries or storage, generic storage. It's really not an easy task. Hydrogen, even more questions there. And we've been doing lots of work on hydrogen for quite some years now. Problem with hydrogen is there are lots of issues, but it's an energy vector which needs incentives on both sides, on the demand and on the supply. It needs incentives in the midstream, in how you take the hydrogen from where it is produced to where it is consumed. Right now, there are quite a few decisions to be made on whether the regulatory framework enables electrolysis to be produced with PPAs, and with the wind or solar plants being far away from the electrolyzer, so that the best resource is taken. But then somehow the regulator needs to find a way to remove the grid connection costs. Grid connection costs completely kill hydrogen, but also the need to have the solar or wind plant next to the electrolyzer, it completely kills the business case for producing hydrogen where it's not sunny or windy, which is not, and then you need big pipes, which also make it expensive. So, every situation you think of has a problem or has a need to adapt the regulation. The way forward, in our view, is the regulation removing the grid charges for electrolyzers. We think electrolyzers need to be close to the demand, and we think the production of wind and solar to feed those electrolyzers needs to be where the high resource is, whether it's in the south of Spain or in the north of Europe, in offshore. So quite some regulatory challenges there. But definitely hydrogen, back to the question, it's definitely part of the future. We'll see how much. We think in general, and our views are changing here. I mean, we keep updating them as technology tells us whether it will be cheaper to try decarbonize some industrial processes with heat pumps or with processes that use electricity to produce very high temperatures, or whether hydrogen will definitely be the only solution. So our numbers keep evolving, as we realize where the technology is and where the regulator is, but it's definitely a part of the future. Just a bit slower, I think, than the current appetite, which has been rising in the last few months. There are lots of issues in the delivery, not so much, in European money or incentives can make anything profitable. But that's just one part of the issues. The other part is, okay, you've got that cheap hydrogen. How do you take it to the customer? How do you guarantee a flat supply or a fairly flat supply of hydrogen without oversizing a lot with batteries or with on-ground tanks? So quite some issues. We think that technical and regulatory barriers will make things go slower in the hydrogen space than the current ambition.
We get as well some questions around allocating the risk in the right way. Today, as you said, people go through very complex PPAs, lengthy lawyers get it together. There are some standards out there from EFED and others.
Right.
I think this goes towards the standardization as well. But the way towards trading the energy directly on a wholesale market seems to be a long one. Who can lead that way? Is it the existing utilities, or is it really the developers themselves who become more and more active on the wholesale markets?
You mean the trading, taking the energy physically to the market?
Yeah.
Well, in general, what I think makes sense, I mean, the practical aspects of taking the energy is solved well by market representatives, which charge small fees, basically to manage your energy. Yeah. And the whole risk, they do a pass-through. They just charge a small fee, and they'll manage your energy. An option is that you become, as a developer, you build your own control room, you deposit all the guarantees to operate in Omnia, in Electrica. If you're a small developer, I don't think that really makes sense. There's little savings to be made there, as I see it personally. So the risk of the wholesale market price, the entity you would pass this risk to is not the market representative. They'll just do a pass-through. Mm-hmm. The question is, so do you pass it? Do you go to a forward product and lock in a price, and you're passing? I mean, you're sharing the risk with the off-taker of this contract, whether it is a PPA or simply a forward product. I think a lot of the risks also need to be understood in the product that you trade. Some people might think that a baseload product is a very good hedge. It would be the case if capture rates stay very close to 1. It is a very poor hedge if capture rates go below 1. Guess what? We see them going well below 1 in the case of PV. So either you develop products which adapt very much to your profile, and you basically you pass most of the risk to the off-taker, because the best hedge on the producer side is pay as produce, 30 years fixed price. You sleep perfectly well. Well, even then, you're still left with understanding what happens with curtailments, because pay as produce. If you produce 10% less, if you go to the market, you don't produce your megawatt because you bid the minimum you're allowed to, and the market operator says, pro rata, we need to curtail everyone. I mean, it's not even then curtailing; it's just saying, thank you, but we don't take your bid. You'd say, how come you don't take my bid? I'm bidding 0 or 0.01. The market operator would say, well, there are more megawatts bidding your price than the actual demand. There's no alternative, but you need to curtail your plant. So you're still left with that risk, even with a perfect profiled forward product or PPA. But as long as the first step is build the instruments to try hedge, and then chances are you will find a counterparty to be on the other side. It's obviously a matter of finding the right price which works for both. How does someone manage the risk? Someone who's on the other side of paying the electricity. Basically, they diversify ideally in having the demand. So basically, you try hedge as much as possible a consumption. So either you lock down the sale of this electricity with a corporate or with a supplier. The difficulty with suppliers being that consumers are free to leave anytime in electricity, like in every other market, right? So it's difficult for a supplier to know, to guarantee that they'll have the same number of customers in 5 years' time. So ideally, you want this is why I said that I think in the future world, best hedge and the best way to operate in this business is try and be in several sides of the business and not just on one. You can live being just on one, if you have the right hedge, or you took the right risks. But I don't think that's how businesses can be managed. I mean, no good government will allow a business being run in such a way that if something happens, you go bankrupt and you go out of business, right? Yep. So I think companies need to understand more and more the benefits and of being on several sites, and that's the way to really sleep well, knowing that, you know, if you are locked down in a PPA or a forward that's not good, I mean, that happens to be out of the money, then you compensate on other parts of the business.
Yeah. I mean, that would favor the big players again in the market. I hope that market can play a role as well.
I don't think it's a question of size. I think, you know, you can have small businesses which are efficient, even more efficient than the big companies. Lots of players are buying or building from scratch a supply company. Of course, it takes a bit of money and time to have a customer base, but I don't think you need to be huge. You just, you know, you need to be on several sites and diversified. As long as in relative terms your business units are balanced, I don't think it's a question of being enormous.
Good. You're running a little bit out of time. We're already past an hour. I think we could continue for a while because we still have about 20 questions or so here which we haven't answered. So
a few more minutes, no problem.
Let me
trying to read out questions, but feel free to
let me pick up
any of the interesting ones.
Let me pick up one here. The interconnection topic comes up as well. Spain being not fully connected to other countries. Do you see there additional capacity being built? And
yeah, so interestingly, with interconnections, with the new future going towards the net zero, basically developing renewables everywhere, and those renewables not be very frequently not being correlated.
Yeah,
it means that the price differentials in the futures will rise as long as the interconnection is limited. Obviously, if you had a copper plate, there will be no price difference, but many countries are very, very far from this copper plate. So interestingly, we do see some interconnectors, and in a specific case of Spain and France, with interconnectors being very profitable, even on a merchant basis, forgetting about the typical social welfare studies that regulators do. So a regulator should not care explicitly about the interconnector itself being profitable by, you know, the revenues from price differentials paying for the interconnector. This is not how the regulators work or should work. The approach to interconnections is, what's the social welfare in the country created when, you know, we pay $1 billion for this interconnection? What are the different benefits which go beyond the collection of money from price arbitrage? Eventually, you could have an interconnector that sees very, very little revenues from price differentials, but there's a huge social welfare in the country because you export more and because you access cheaper electricity. Actually, the numbers we see are that just forgetting about the social welfare and just looking at the revenues a merchant interconnector would make from price differentials, there's a market for huge capacity to be developed between Spain and France. So the question here is the bottlenecks or the constraints in the, let's say, the political and technical aspects. It's definitely not a problem of money. I don't think it will be a problem of political will. It's really very long projects. It takes generally a good 8 to rather 10 years to develop projects, just because the technical studies are tremendously, you know, problematic. The cables, in the case of Spain, France, they would very, very likely need to go underground. There's already one underground. Future ones would also need to go underground. This is terrible technical problems, many kilometers to dig in the Pyrenees. There are huge environmental issues with the very south of France being a natural park, where no one wants a tower So you almost need to dig a cable, dig a tunnel and lay a cable that goes from way below the Pyrenees to way above the Pyrenees. Not as far as Paris, but almost. It's tricky. So it's one of the big question marks for us. I mean, the economics, everything suggests more should be developed. We do think more will be developed than the Biscay Gulf, which is all set for 2026 or 2027. Mm-hmm. Beyond that, we think there will be more, but we think it's future decades. So careful in your scenarios, because assuming that lots of capacity, interconnection capacity comes by 2030, mm-hmm. is a very strong assumption.
Excellent. Look, we can pick up some of the questions as well and maybe respond to them on email, I guess, or I guess you're happy as well to take further questions after the session via email. For the moment, big thank you to you, Javier. It was really interesting. Great overview on the market. And yeah, we keep in mind that there are some risks in this business evolved and where
in mind also the opportunities.
Sure.
Side, but yeah, definitely. As I said, it's not just this decade, but 3-4 decades with lots of activity going on. Yeah. It's a matter of being realistic, hedging, trading, using enmacc as much as possible.
Oh, thanks.
So bright future, and happy to help and keep in touch.
Great. Thanks a lot to everyone in the audience as well. Thanks for participating with so many questions. And I hope to see you back in about 2 weeks when we have the next session. Thanks a lot, everyone.
Great. Bye-bye.